I'm joined now by Wolf Richter. He is the publisher of wolfstreet.com. Wolf, welcome.
Thanks for having me.
You bet. Wolf, since this is your first introduction to my audience, can you give us a quick thumbnail on how you come to know so much about the Fed and its operations?
Well, I'm a Fed watcher, so that is one of my little niches that I'm in. And it started in the financial crisis when the Fed started doing all sorts of shenanigans. And you know, it is fairly transparent about some of the things that it does. So it publishes some of the data so you can actually look at it and see it. And it's just been a fascinating experience in how it has progressed. Essentially manipulating the markets and taking any kind of price discovery out of the bond market, especially, and that has been it's one of its primary goals. You know, so it wants to set interest rates, and meaning market rates. It wants to set market rates. It can't really set them, but it wants to manipulate the markets to where they have particular rates. And yeah, it's just a very fascinating experience to do that.
Sure, you bet. You wrote an article on February 7th making the case that the Fed was winding up a sort of de facto quantitative easing operation in the guise of overnight operations in its repo market since September 2019, when there was a sudden spike in the overnight rate of interest that the repo market participants were willing to lend money at. Can you outline for my audience, please, how this repo market works and how that operation affects or sort of replaces QE when they resort to printing extraordinary quantities of funds to service that interest rate?
Yeah, so let's briefly go back a step. There are four big things that the Fed does with its balance sheet. Two of them were part of QE, and so it would buy Treasury securities of all kinds, except Treasury bills. So those are the short-term bills. It didn't buy any of those during QE, during the later stages of QE, but it bought the long-term securities and then mortgage-backed securities. So it would buy those mortgage. During the QE unwind that started in late 2017, it started shedding those securities by letting them mature and roll off the balance sheet. And then we got, and that worked fine until we got that stock market plunge in late 2018, and then the Fed sort of did a U-turn on these two items, on mortgage-backed securities and Treasury securities, and gradually stopped the unwind of those. And then we got, when it just had stopped them, you know, essentially we got the repo market blowout in September 2019. And so now it added two more components to its toolbox. And so there are now four components. And so the two it added are the repos, the repurchase agreements, and buying T-bills, so Treasury bills, short-term Treasury bills. And they don't always go in the same direction. For example, it is still shedding mortgage-backed securities at a rate of about 20 billion a month. And so that's happening. That continues to happen. The Fed wants to get rid of its mortgage-backed securities, and it's unwinding its positions gradually, getting rid of about 250 billion a year. And that rate has continued. Then it had in September, it started getting into repos. So these are repurchase agreements where it sells, it offers a certain amount of cash for Treasury securities and mortgage-backed securities to the repo market. And these are short-term, so some of them are overnight repos. So there's a repurchase agreement. It means I sell you something, and then we agree that the next day we reverse that transaction for a slight gain for me. And it's like a loan, but it's really a purchase with an agreement to repurchase the original item. And so the overnight repos then unwind the next day, and the Fed does them every day. And so they go to zero the next morning, and then there's a new one coming after that. And that goes to zero the next day, and then there's a new one. And then there are so-called term repos, and the current ones there for 2 weeks, 14 days, and Fed does 2 a week. And so there's always 4 of them outstanding. and they unwind in 15, usually 14 to 15 business days, and then there'll be another one. So, for example, this morning it did a 25 billion term repo. So this is down from the 35 billion repos it did late last year and earlier this year. So it is gradually reducing the amounts of these term repos. And so from 35 to 30 billion, and now we're down to 25 billion, and pretty soon we go to 20 billion. And so it's gradually taking those off the market. There was a 50 billion 30-day repo that it did in December that carried through early January. That unwound without replacement. So when these repos unwind, the balance on the Fed's balance sheet go to zero. Everybody takes the Fed gets its money back, and the counterparties get the securities back. So this has had the effect that the repo balance has plunged from about 260 billion at the end of December to about 164 billion now. And because it's gradually winding down, it got rid of the 30-day repo. It's gradually winding down the 14-day term repos, and the overnight repos have been undersubscribed all year long. So they're now running in the range of 30 to 50 billion a day, and they unwind the next day, and then there'll be another one. So this entire repo episode is winding down. And the Fed is now discussing a permanent repo facility, which would be there if these repo rates spike. And so there wouldn't be any big to-do about it. The Fed could just step in. It used to have a standing repo facility before the financial crisis, and it used it constantly. So there was constant repo activity. During the financial crisis, the Fed started buying all the securities, so it ended the repo program. Now it's thinking about reinstating a permanent repo facility that will interfere in the market on a fairly small scale when needed. Yeah, and so the repo thing is now winding down. The T-bill thing is doing the opposite. So the Fed has decided that one way to solve the repo blowout is to add liquidity to the system via short-term Treasury securities. So the Fed is buying those short-term Treasury securities at a rate of about 60 billion a month. So it means that it's buying them at a rate of 50, it's adding to its stash at a rate of 50 billion a month. They mature constantly. They're 30 days and 90-day securities, so they're now maturing. And when they mature, the Fed replaces those, and in addition, it adds about 60 billion a month. So we've got those three different directions going. The mortgage-backed securities are declining at a rate of 20 billion a month. The T-bills are increasing at a rate of 60 billion a month, and the repos are now declining at a somewhat uneven rate, but have come down quite a bit. So the net effect has been that in terms of the Fed's overall assets, they really have not moved since the end of December. They kind of wobble up and down a little bit, but they have been essentially flat. So that huge pileup of assets that it did, that $410 billion that it added, from the mid of September through the end of December, that has, that's still, those assets are still there, but they're not increasing anymore. So the QE part of it is essentially gone. It's just maintaining its levels right now by increasing on one side and decreasing on the other side.
Interesting. So with the permanent facility in the repo market, I guess that is in part designed to prevent any sort of spike in rates, which occur when the participants in the repo market say, "Hey, we're not going to give you our treasuries. We want to hold them because we're not satisfied that interest rate at 1.8, 1.6 delivers enough of a offset to the risk associated with an overnight operation?" Or what is it that causes the overnight rate to spike? And I'm pretty sure you're going to tell me it's because the participants withhold, participation based on an effort to drive a higher rate into the market. Is that correct?
Yeah. So we don't really know yet because the Fed has not disclosed exactly what's causing it. The Fed has said it's studying the causes. Some things have emerged, though. So we know that the big banks, including JP Morgan, refuse to lend to the repo market. So they refuse to supply the liquidity starting in September. And this happened at the end of 2018 as well, but it was a short blip, and in September it was not a short blip. And so we know that. So we know that there was a shortage of supply and liquidity from the banks that would normally be happy to supply. So when the rate spiked to 3 or 4% and the banks can borrow at 2%, it would be very profitable for the banks to lend to the repo market. And the rate spiked to 10%, so it would have been hugely profitable for the banks to do this. But for various reasons, and that's not being looked at, and some of it, regulatory reasons, other are people saying that maybe the big banks kind of sort of got together and tried to force the Fed's hand on this to loosen up regulations. So there's all kinds of theories floating around. The Fed has essentially said it's going to wait a couple of years before it discloses what it finds. So we don't really know. But we know that on the other side, so these are repurchase agreements, so there's another side to it. And the other side is entities that fund their own investments in the repo market. So they're borrowing in the repo market. And these institutions include, obviously, banks, but also hedge funds and mortgage real investment trusts. And we don't know anything about hedge funds, but we do know something about these mortgage real estate investment trusts because they're publicly traded. And so we can go to the SEC and we can look up in the filings what they're doing. And I did that, and I looked at one of them, and all they do is they make money off the difference between mortgage-backed securities, which is what they earn money, and the cost of the funds when they borrow in the repo market. It's very low, so they have a pretty good spread there, and that's all they do. They leverage that spread, and so they make long-term investments. They buy mortgage-backed securities, which are long-term investments, and they fund them short-term in the overnight repo market, and perhaps with 2-week money, and some with a little longer in the repo market. So they're forced borrowers. They have to borrow. So when the repo market dries up, when it locks up, when the rates spike, they have trouble borrowing, and they can no longer fund the mortgages, and they would have to default on some of their obligations. And the one I looked at had $110 billion in mortgages sitting on its balance sheet, and that's a pretty good chunk. And if that started, and there's a bunch of others like this, it's not the only one. It's just the one I have to look at. And so you're talking maybe $1 trillion in mortgages, in mortgage-backed securities that are sitting in these funds that could possibly, these funds could possibly blow up. The mortgage-backed securities are good, but the funds that are holding them, they have to fund them in the repo market. When the repo market doesn't supply the funds, this whole scheme falls apart. And I think the Fed saw this. And the risk is that contagion spreads from these hedge funds and these mortgage REITs, and that it will impact the overall financial system given how big the numbers are. And so the Fed sort of panicked and jumped in trying to solve this. And I think it was this combination of the banks not stepping up to the pump because of various reasons, and then the forced borrowing that's going on in the repo market on the other side. Now, these organizations, these financial institutions that borrow in the repo market, they can't just borrow somewhere else overnight. This is something that's in the system. It would take a long time for them to find other sources of money. So they're really dependent on the repo market, and they disclose that in the financial statements that say that's one of the risk factors. If we can't borrow in the repo market, we may go out of business. We may blow up. They say this, and so I think this is the other side of the problem, where these big funds could no longer fund the long-term investments with overnight repos, and and it got to be very risky. And I think the bigger issue is with these institutions and how far they have come to rely on the repo market. It's very risky to to invest long-term and fund those investments in short-term markets. I mean, banks do that all the time, but banks are FDIC insured and heavily regulated. These funds are not regulated, and when they do it, it gets very risky.
Mm-hmm. So then what is the implication for the, like, what's the risk to the broader economy and the market generally?
Well, when the financial system blows up, as we have seen, I call this the coronavirus in finance, things come to a halt. So that's not a good situation. If it's just limited to the repo market, I would have liked to see that, actually. I would have liked to see there to be some damage on the borrower side in the repo market so that they pull back a little bit. The repo market, there's $4 trillion in transactions every day. It's huge. There's a lot of people involved in this. And the Fed is just a small player in it. And so there's a lot of companies that rely on the short-term funding to finance long-term projects, and it's very risky, and it would have been nice to see several companies blow up in this so that that some of the risk gets taken off the table. And that's the thing that the Fed tries to prevent all the time. It's social, it's a moral hazard. It's trying to avoid that anybody's learning any lessons in this, and so it bailed the repo market out. And it now the lesson is that the Fed will always bail out the repo market. There's no risks involved in borrowing in the repo market. And so if it's just limited to the repo market, I don't think the real economy will suffer. If there is, and I would have liked to see that, if the contagion spreads throughout the financial system and starts blowing up some of the big banks, which I doubt, but it could, I think this will be a huge issue.
Wow. Wolf, I could probably talk to you for hours and hours on end. Unfortunately, we've run out of time today. I will come back to you, and I really appreciate your time today. Thanks for joining me.
Thank you, James.
On your line, Sophie.